many people, investing is the scariest and most confusing part of managing money. To see how scary it can be, just look at what happened in 2008. In less than 18 months, the U.S. stock market fell by over 50%. Several major financial institutions either went out of business or had to be bailed out by the federal government. It was a frightening and uncertain time. If you had money invested in the stock market then you probably remember that time all too well. Investing can also be confusing because it comes with its own unique terminology. Bull markets, bear markets, asset allocation. All of this could make you wonder, who needs the stock market? Well, in short, you do, and so do I. Hi, I'm Kisa, and welcome to Multiply, a 4-part study on taking a biblical approach to investing. Multiply was developed by Sound Mind Investing, a Christian organization that's been helping people like you and me become better investors for more than 25 years. The name Sound Mind Investing comes from 2 Timothy 1:7, which says, "For God has not given us the spirit of fear, but of power and of love and of a sound mind." This study was designed to replace any fear you might have about investing with the knowledge, confidence, and biblical foundation you need to invest well.
Welcome to this study about taking a biblical approach to investing. I'm Mark Biller. The Bible says a lot about money and offers many important investing principles. In the parable of the talents, Jesus described a wealthy person who, before leaving on a trip, asked 3 of his servants to manage his property while he was gone, entrusting different amounts based on their different abilities. The first 2 servants doubled what was entrusted to them. When the master returned, he strongly affirmed both of them and gave them each more to manage. But the 3rd servant was scared of the master, so he hid what had been entrusted to him and gave it back upon the master's return. Now, he didn't lose any of the money, but he didn't do anything productive with it either. Because of that, the master rebuked him, telling him he should have at least earned some interest with the bankers. This story shows us the foundation of biblical money management, recognizing that God is the creator and owner of everything, and we are stewards or managers who've been given the responsibility to manage wisely what he's temporarily entrusted to us. This parable also makes clear that God expects us to do something productive with what he entrusts to us, to multiply it through wise management. This brings us to one of our more specific financial responsibilities, providing for our families. 1 Timothy 5:8 says, "Anyone who does not provide for their relatives, and especially for their own household, has denied the faith and is worse than an unbeliever." Ouch. That principle applies to us today, and it will still apply down the road when we're older. Of course, earning money is the most basic way we provide for our families. But if we're going to continue providing in our later years, in retirement, it's essential that we set aside a portion of what we earn now and then manage that money in a way that makes it grow. We can't just put that extra money in the bank because inflation will likely erode its buying power. We have to do something more productive with it so that we'll have enough to take care of our families in the future. Now, there are 2 key issues here: the need to set aside enough money to cover our later life expenses, and the need to manage that money in a way that makes it grow. Let's look at each of these. As you probably know, people are living longer than they used to. If you were born in the U.S. in 1900, your life expectancy would have been less than 50 years. But people born today are likely to live to at least 80, and many are going to live even longer. Now, of course, that's great news, but from a financial standpoint, it means many years of living expenses to cover when we're older. Now, while many people say they'll just work longer to cover these retirement expenses, the reality is few people actually work much past the traditional retirement age of 65. Some people have health problems that force them off a job, or they leave the workforce to care for loved ones, or they get downsized out of a job. The bottom line is, most of us will need to have enough money set aside by our mid-60s to help cover our living expenses for at least another 20 years. So that's the first challenge as we consider how to provide for our families in the future. The need to set aside enough money today in order to cover our living expenses for many years after we stop working. Here's the second challenge. To an increasing degree, it's up to us to manage that money. Historically, retirement income has been described as a three-legged stool with three main sources: Social Security, your own personal investments, and a company retirement plan. It used to be that individuals were responsible for just one of those sources, their own personal investments. But today, many of us are also responsible for a second leg of that stool, managing the money in our workplace retirement plan. That's because old-style pension plans largely have been replaced by 401k plans. With old-style pensions, the company did all the work. They decided how much money had to be put aside to cover your retirement pension, and that money was managed by professionals. When you retired, the monthly checks just started showing up. Easy. But with today's 401ks and similar plans, it's up to you to choose how much to contribute, how to invest that money, and then in retirement, how much to take out each month to live on. Bottom line, over the course of a career, most of us are going to have to save quite a bit of money for retirement. And it's likely going to be up to you to manage how that money is invested. Before we go any further, we need to make an important distinction between saving and investing. Both are important to your financial health, but they're not the same thing. Saving is for short-term needs and goals. You generally keep savings in a bank or credit union, and we recommend you keep a savings account for emergencies that has 3 to 6 months worth of essential living expenses. With savings, earning interest is great, but it's not the top priority. You really just want the money to be there when you need it. So safety and ease of access are the most important considerations. In contrast, money that you invest is for long-term goals, like retirement. With this money, you're trying to earn more than the rate of inflation. Otherwise, your buying power will be reduced over time. Thankfully, you should be able to do better with your investments than just keeping up with inflation. And the better the rate of return on your investments, the faster your money will multiply. For most of us, the main investments we'll use to pursue our long-term goals are stocks and bonds. Sure, there are lots of other investments you can make: rental real estate, precious metals, even things like timber, farmland, and oil and gas partnerships. But most of these other investments either require a lot of money or they're not likely to be available through a 401k plan at work, which is where most people these days do the bulk of their investing. That's why the main focus of this study is on stock market investing. The stock market is where ownership shares of publicly held companies are bought and sold. For relatively small amounts of money, you can buy tiny pieces of some of the most well-known companies of the world. Importantly, the long-term returns from the stock market have been better than those of most other asset classes, like gold, real estate, bonds, and cash. And stock market returns have been 3 times better than the average annual inflation rate. To really understand the potential of investing, you need to grasp the power of compounding. Albert Einstein reportedly called compound interest the 8th wonder of the world, and it's one of the most important concepts in investing. Here's how it works. Let's say you invest $200 and earn 10% on that money. 1 year later, you'll have $220. Your $200 would have earned 10% or $20. The next year, assuming you're able to once again earn 10%, you won't just earn another $20, you'll earn $22. That's because you'll have earned 10% on your original $200 and you'll have earned 10% on the additional $20 you earned last year. So far, this may not seem like a very big deal, but it is a big deal. To see just how big a deal it is, let's look at the results generated by an investor named Claire. Claire's a go-getter, especially when it comes to investing. When she was just 20 years old, Claire started investing $200 per month. She kept at it for 50 years and generated an average annual return on her investments of 7%. Some years she did better, some years she did worse, but her returns averaged 7%. Let's look at Claire's progress after 10 years. At that point, she had invested $24,000. That's the total of the $200 she invested every month for 10 years. But because Claire was able to generate that average return of 7%, the power of compounding turned her $24,000 into over $34,000. She earned over $10,000 on her investment. Nice, right? Let's skip ahead. After 50 years of investing $200 per month, Claire had invested $120,000, an impressive accomplishment by itself. But look at the total value of her portfolio. Her 7% average return generated nearly $970,000 more. Wow, that $120,000 investment turned into nearly $1.1 million. Again, this was done with just $200 per month, earning 7% per year. Chances are, Claire could have accumulated even more. As her income grew over time, she probably could have invested more than $200 per month. Many employers also match a portion of what employees contribute at work, which could have boosted her contributions further. And 7% is a pretty conservative assumption for a rate of return, especially for such a long time period. In other words, that $1 million figure easily could have been even more. The 3 keys to Claire's success were: 1, she made it a priority to set aside a portion of her income every month to invest. 2, she generated a good rate of return on her money. And 3, she did this for a long time. These keys bring to mind the principle taught in Proverbs 21:5. Steady plodding brings prosperity. Let's look a little more closely at each of these 3 keys to success. First, Claire set aside a portion of her income every month to invest. In session 4, we'll help you figure out how much you should invest each month. The earlier you get started, the smaller that monthly amount can be. Second, Claire generated a good return on her money. To illustrate this, let's compare Claire's results with her friend Alex. Alex started investing $200 a month when he was 20 years old, just like Claire. He also kept at it for 50 years, just like Claire. But Alex's conservative nature caused him to choose less risky investments. Over time, his average annual return was 6% compared to the 7% that Claire earned. As a result, Alex ended up with just $760,000, quite a bit less than Claire, who ended up with more than $1 million. That's amazing, isn't it? Alex's average return was just 1 percentage point lower than Claire's, but his ending balance was about $300,000 less. Clearly, the rate of return you earn on your investments is really important. As we saw earlier, the the stock market's long-term average return has been substantially better than the 7% we're assuming. It's actually been nearly 10%. The third key to success is time. Claire put time on her side by starting to invest as early as possible. To see how important time is in the investing equation, let's compare Claire's results with those of another friend, William. At age 20, William had a lot of things he wanted to buy. So many things, in fact, he couldn't come up with any money to invest. He figured, I'm young, there will be plenty of time to invest later. So William didn't start investing until he was 30. At that point, he did the same things Claire did, $200 a month, earning a 7% return. The only difference was he got started 10 years later. At age 70, after 40 years of investing compared to Claire's 50 years, William had invested $96,000. That's just $24,000 less than Claire. But William's investment account was worth only about half the value of Claire's. The lesson? To take full advantage of the power of compounding returns, set aside a portion of your income every month to invest it in a way that provides a good rate of return, and put time on your side by getting started investing as soon as possible. So what if you're not 20 years old? The principle remains the same. If you're 40, it's better to start now than waiting until you're 50. If you're 50, better to start now than when you're 60. The sooner you start investing, the better. In our next session, we'll look at various types of risk involved in investing, along with the best ways to manage those risks.